Hello and welcome to this Astranti video. Today we'll be introducing you to the statement of cash flows, exploring what it is and why it's important. This is an extract from our video on F1 chapter 9, but it will also be useful for those of you studying F2 because that deals with group accounting, where a good understanding of cash flow statements is vital. If you want to watch more videos on this topic and many others, they can be found on the Astranti website as part of our full course. But for now, let's jump straight into this introduction to the statement of cash flows.
Before we start constructing a statement of cash flows, I want to take a look at why we have a statement of cash flows and take a look at the purpose behind the statement in the first place. Because when I first came across this statement, I didn't quite understand why this was a separate statement from the income statement, for example. I was sort of thought most of it was covered in the income statement and the statement of financial position. And I thought this is just one of those statements that isn't really necessary. And it was only after a little while that I really realized the importance of the cash flow statement and why it was different to the income statement. So I want to start with a little sort of scenario which should hopefully highlight that difference. So if you take a look at your bank balance, you might have a lump sum of cash, but where did it all come from? Now, some of it might be your wages that have been paid in by your employer, but perhaps some of it is interest from the bank, and maybe you sold an item on eBay during the last month and you received a payment from PayPal for that. So there's all sorts of different incomes that have gone into this single balance. You're not entirely sure how much of it has come from which source. Equally, you may wonder where it's all been going. Again, if you just have this single balance, you don't know exactly how much you've spent on bills, on rent or mortgage, on expenses, on food, on shopping, maybe on taxes. You just have this single figure. Wouldn't it be really useful if you had a statement that broke down all of your cash expenses and payments during the last period, so you had an idea of where you'd been spending money or where you'd been earning money on different things? And if they'd categorize that into useful topics such as maybe rent or food or leisure expenses or something like that, then you'd have really detailed insight to how you'd spent cash over the past month. Well, that's roughly the thinking behind the statement of cash flows. The idea is that a company produces a statement to get a really clear idea of where they've spent cash and where they've earned cash in the previous financial period. And one of the key things it shows, and that's why it's different to the income statement, is that just because a company is profitable in their income statement, let's say they've made a decent net profit, that doesn't mean they're going to be cash rich. Equally, just because you've got a big cash balance doesn't necessarily mean you're profitable. To give you an example, you might be a very profitable company. You made a large profit for the year, but your cash balance might be very low because you spent a lot of money during the year investing in new projects and buying new assets and new machinery, and you bought some new buildings. So that's a lot of cash expenditure. And with that expenditure, you're investing in your future, expanding the company, investing in growth so that you can make bigger profits in the future. So just because you made a big profit doesn't necessarily mean you're going to have a big cash balance, particularly if you're investing that. Okay, it also helps us to assess the company's cash position. So essentially, by answering those questions earlier on, where is the cash coming from? Where is it going? What are we spending it on? We get a better understanding of how and why the cash balance has changed over the past 12 months, why it's either increased or decreased. And by giving a detailed breakdown of the company's cash position, the statement of cash flows will highlight any serious cash flow issues that didn't come up in the income statement or in the statement of financial position. So enough with the introduction and the purpose behind it. It's time to get into how the statement actually works, what it looks like, and sort of how it breaks down. So as I've sort of already alluded to, we're going to start with our opening cash, and that's the balance that we finished the year with from the previous year, or what we open the year with. So our opening cash balance is A. We have our closing cash balance, so the closing balance that we have for the year, what we've ended up with, and that's what we're shown
in the statement of financial position. So A and B, the opening and closing cash. And as we've mentioned, that doesn't really give much of a detailed breakdown of how the company has used cash in the previous financial period.
So what we're trying to find out is more about the change in cash and what has caused the cash to change. So essentially the difference between opening and closing cash. So what we look at are cash inflows, and we look through the income statement and we look at all the cash flows into the company and we consider those. And we do the same for cash outflows, for all the actual money that the company has spent on things during the year. We subtract those, and that tells us the change in cash flows during the year. So overall, whether or not we've spent more cash than we earned. So this is roughly the kind of logic behind the statement. Now, it's not always necessarily the case that it's a good thing for the company's cash balance to increase. A decrease in cash can be a good thing. As I mentioned earlier, if you're investing in the future, if you spent a lot of cash during the year investing in non-current assets, maybe you bought new warehouses, new machinery, so you have better productive output, then that's investing in the future, and potentially it's going to reap the rewards further on down the line. So it can be a good thing to spend cash. And in fact, just having cash sitting around, not really doing anything, is generally considered to be poor business practice. So spending cash can be as good as holding on to cash, and it really depends on the goals of the company. Okay, so here we really get into the key idea of the statement of cash flow. Now, it might seem obvious, but hopefully you'll see why this is worth pointing out in a moment. So in the statement of cash flows, we are only considering cash transactions. That's it. Now, as I say, that may seem obvious, but there are plenty of transactions that are non-cash transactions that are included as income and expenses that are showed in the income statement, and we need to basically discount those. So when we're talking about cash flows, we're really looking only at cash inflows or cash outflows, so literal payments or receipts of money. That makes it different from the income statement in a number of key ways. So one of the key things that we have in the income statement, one of the main expenses, is the depreciation expense. And that is the way we spread the value of non-current assets over their useful life. So a depreciation charge in the income statement, it's always there, but it doesn't actually represent any movement of cash. It's just an accounting technique. And so there's an example of a non-cash transaction that it's included in the income statement. It has an impact on the profit calculation, but depreciation charges, that doesn't have any impact on the cash balance because it doesn't cost us any money to have a depreciation charge. So this is what we mean when we say it's cash only. It's important to get your head around that early on, that we're really only interested in actual cash payments or receipts. And this is why it's possible to have instances where you have companies that look really good in their income statement, they've made really good profits, and yet if you look in their cash flow statement, the net cash flow is poor and they may have significant cash flow issues. So it's important to distinguish between profit and cash and understand why that difference is important.
So we're now at the end of this Astranti video, but there are more to be found on our website as part of our full course. On there you can also find mocks and revision notes to help you pass your exams. If you want to hear more from us, why not subscribe to one of our social media accounts? We can be found on Instagram, YouTube, Facebook and Twitter. Thanks for watching.